I kind of want to circle back, if you don't mind, and if you're not comfortable kind of addressing this, that's okay too. We can kind of move on. But is there anything you can kind of share about current positioning and dealer positioning? And this is kind of where you typically derive your commentary for, when you do chime in on Twitter, for example, which I've always loved. And I think you've been doing that less frequently. Maybe you're getting more busy, or maybe you're just finding that there's too much toxicity, or, it's not worth it for whatever reason. But I think a lot of this, the flows discussion is kind of what motivates some of your really great Twitter threads. So maybe what I'm asking is, can you kind of like on the spot put together kind of a short Twitter thread on what is current positioning and what does it kind of say about what we might expect coming into the end of the quarter?
Sam will have to share his screen to do a meme and a GIF with every
that's right.
He makes.
That's right. Put some emojis up.
Certainly the king of GIFs
up
for
on the
sure.
screen as I talk. Yeah, absolutely, no problem. I mean, why have I not been doing this on Twitter as much? Because the more, when I had 5,000 followers, it was fine. But with kind of 85,000 traders, a lot of these are heads of PMs at Citadel and Susquehanna, and there's again, I know who's following me, and it does have reflexive effects. So I'm better off not saying the bigger the funds get and the more important this is. So that's a big part of it, quite frankly. But to speak, more directly, we only have, I think, 150, 200 people on here or whatever it is, so I can be a little more candid. The reality is right now is very important for dealer positioning. There are several major structural trades that have been quite unique during this period, and this is also just a broad, unique period in terms of market move, right? One of them is this JP Morgan trade, which you guys have heard me talk about, but there's a JP Morgan hedged equity product that puts on a massive, structured put spread collar, right? It buys a put spread and sells a call over its equity. And it does that quarterly. It actually does it monthly now as well. But the quarterly one is by far, that's the oldest and the biggest. And it overwhelms the size of any other trade that's in the equity indexes, at least. And it's not the whole story, but this is a good example of some of what's happening. There's also a lot of structured, products that are tied to these quarterly expirations, and so there's a lot of, again, click out options and auto callables and a lot of these other exotic instruments that ultimately also affect the June. But all of them have, not all of them, but most of them have similarities and tend to have similar effects. And what we've seen in the recent decline is immediately under the market, a lot of, based on this JP Morgan trade and other trades, dealers have been massively long vol. They have been long, 3600s, 3650s, 3700 area in the market in the June expiration. So that has led to an oversupply of vol, has led to we've all seen an underperformance of vol, because ultimately that's actually the expiration practically you want, because it's the Fed, because it's a lot of other things that can give you a hedge for events and other stuff. So people have been able to sell other things against it ultimately, because they have this massive amount of vol kind of where they want it. And that supply has led to massive vol compression, and has led to some of this delta buyback that we've talked about along the way, which has led to these massive bounces. We saw one in March last quarter. There was a 10% ripper right before March quarterly expiration, and it's led to a lot of buyback as vol has compressed, in other products. But as you approach that expiration that you've been long, right? Dealers are about to decay now. They went from decaying longer and longer and longer vol because they were moving towards our longs, and the stuff they sold both in front of it or whatever that was expensive has gone away or is going away. But as you approach that June expiration, now that massive vol supply starts to dissipate. They're all trying to roll their expiration, the vol, or maybe, they're not hedging as much, right? And on the customer side, because vol has dramatically underperformed, you had a lot of puts in portfolios, be liquidated right into the decline. People are like, well, this hedge has not really worked that well. I better take the money while I can, or I'm not going to have, or I'm going to be worse off than I would have been without the hedge, right? And in the equity vol space, a lot of people who are at the top thought this would be something that would hedge them, and have been poor, unfortunately poorly. The outcome has been very poor, and they've been very disappointed. So that's led to even more vol supply. So it's kind of a reflexive loop where there's been vol selling and there's been vol supply, but it's all been concentrated around this June expiration. So it's very important as we get to this point, to take a look at that and understand that as this rolls off, there's some fragility. Now, there are some other things going on here. There's another JP Morgan trade coming. It'll be here in a couple weeks, just over 2 weeks, 2.5 weeks. And that will provide more vol supply, and it'll provide it further out in different places and different things. And people are starting to also prepare for those things and moving around. Again, I'm just focusing on the JP Morgan trade because it's easier. There's a lot of other details that correlate. But broadly, vol is dramatically oversupplied. There's also a broad fear in the market and an unwillingness because of all the macro things going on to for dealers to take more risk than they normally may. This is not a time of necessarily complacency yet. So we continue to see. I mean, today is a great example. Fixed strike vol was dramatically down today. You saw headlines on CNBC about how VIX pops, explosion, fear index. The reality is vol dramatically underperformed, especially given the size of the move today. And again, that's because everybody's dropping into these kind of June options. So, our view is, again, to give more specific commentary, that that vol supply is likely, likely to continue here. We'll have a time of volatility in a realized basis during this window, and it could be very choppy, and especially with the Fed coming up, you could get some real kind of back and forth movement. But broadly, Vega or implied vol will continue to underperform in this window. We believe that as you get past kind of this period, June, July, you're going to start getting more and more people liquidating and less hedged. And eventually there'll be a fade here from the hedges, right? And again, maybe this fall, maybe a little sooner in August or so. But this underperformance of vol lasts for a while. And eventually the losses and the pain, it's too hard for people to hedge and to hold that vol. And the vol selling strategies, I'm starting to hear marketing stories, people coming to me showing, look at this fund. John, what do you think about this vol fund? Look how well it's done in this move. Like, this is a great hedge. I'm like, that's a short vol fund. They sell stuff. Yes, it's up 25%, this year. That doesn't, please don't put your money in.